Should you be laddering your life insurance? In the financial world, laddering refers to when you stagger something, like a CD maturity date, and you buy some that mature short term, some that mature mid-term, and some that mature long term, so that you have an influx of cash flow over a period of time instead of all at once. You can ladder CDs, bonds, you can ladder life insurance. This is what it looks like to ladder term life insurance. Let's say you start with a 30-year term policy, and then somewhere along in your lifetime you buy a house, and so you want to cover your 15-year mortgage, so you add on a 15-year term policy, and then somewhere along the line you have kids and you want to make sure their college education is paid for if anything were to happen to you, so maybe you add on a 20-year term policy. This is what laddering term life insurance looks like. There's a few things to be careful of, or a couple things. You're going to encounter one of these down the road whenever you are dealing with term insurance. This is a stop sign for a reality check, because at some point your life insurance is going to become so expensive compared to the amount of death benefit you're getting that it's not going to make sense to continue. On this policy, you probably won't renew because of the cost of premiums. Probably same story on this policy here. This is why so few term life insurance policies ever pay a death benefit. People do not renew them before they die. It doesn't make sense. The other thing is with laddering term insurance, you have to be careful. Each time you go to add another term policy for some event in life, you have to be in good health. You have to be insurable. Disease or sickness can come along prior to any of these points right here, and if it happens prior to them, it can make this coverage an impossibility, and you wouldn't be able to ladder the way that you intended to if that was your long-term plan. So it's good to have something constant in your life, like a permanent life insurance policy. That's where whole life comes in, and something kind of new in the whole life world, relatively new compared to term laddering, would be whole life laddering. How do you ladder with whole life insurance? Because whole life insurance goes your whole life. Conceptually, this is what a whole life insurance policy looks like inside. Right over here on this scale going upwards like this, you have money. And on this scale going this way like this, you have time. Your premium is going to be relatively low on this money scale. And your death benefit is clear up here. It's going to be relatively high. If this whole box is full of death benefit right here in your policy, you're going to get a certain amount of that kind of like equity buildup in your policy. That's called cash value in whole life insurance. It's going to start slow. It's going to build slowly, and then it goes exponential at one point. And right here, it's going to mature. Maturity of a whole life insurance policy is when the cash value equals the death benefit. If you've ever played Monopoly and you may have drawn the community chest card that says your life insurance matures, collect $100. That's what it's referring to. When the policy matures, the cash value will equal the death benefit. Okay, so now that you have some equity here, you can see that this is good growth here. Everything below this curved line here is cash value, and the insurance company will let you borrow money up to your cash value amount, and they'll hold your policy as equity for that. Just a signature loan you can take out up to your cash value. It's amazing. It's great. This is the life benefits of life insurance. And so the thinking goes, if one is good, more is better. And since it takes time to grow, the sooner you get them, the better the growth. Yeah, that's true. The sooner you get the life insurance, the more growth you're going to see in that policy over time. So let's look at how you would ladder whole life insurance. I've prepared some illustrations here. This is based on somebody who has $10,000 per year to put towards whole life insurance. You can see it going in right there in policy premium. And you can see that this life insurance buys a death benefit, $304,000. Also, here's that cash value we were talking about. This is equity. Think of it like equity in your house. Only this is equity in your life insurance. It's about $7,000 right there. And you can borrow that money on a signature loan. The insurance company will hold your policy in collateral and loan you their money. This is brilliant. You take that $7,000 and you're going to ladder it. And you're going to ladder it so you can have a second policy right away. So you take that $7,000, you put it into this policy premium on your second policy, and it creates death benefit and some equity for you, cash value of $4,700 roughly. Well, let's do this to get a third policy, and we'll ladder a second time. You borrow your $4,700 and you go fund policy number 3 with it. You see the $4,700 going in here. Once again, it buys death benefit and some more equity. You could take that and go ladder again, but let's not. We'll just call it, stop at 3 and go look at how this turns out for us. So I'm going to clear this board right here, and we're going to look at what happens in year 1, year 2, and let's go to year 3 for the fun of it. $10,000 is available in year 1. That goes into your first policy. You don't have the extra cash flow right now to fund policies 2 and 3, but you take equity or borrow against policy 1 to fund policy 2, and you borrow against policy 2 and fund policy 3. Interest is going to accrue on these loans, and they are interest-only loans. All you have to pay is the interest. You don't ever have to pay the principal back. And so that's your plan. You'll just pay interest right now since $10,000 was really all you had to put in it. You'll put in a little more out of pocket to pay interest cost. Year 1 is done. You've got 3 policies. You should see some good growth in the coming years, right? Let's go out to year 2 and see what happens. We've got policies 1, policy 2, and policy 3. Once again, these policies 1 and 2 have loans against them because we took loans to pay for 2 and 3 respectively. And we've got to do it again this year because we only have $10,000 going into policy 1. We don't have money for premium on policy 2 or 3. We will borrow against policy 1 again to fund policy 2 and borrow against policy 2 again to fund policy 3. This will result in a little more interest. We don't have to pay the loans back, but we do have to pay the interest on them, and the interest just got bigger. Now let's go out to year 3. Again, $10,000 available for policy 1. We do not have the money for policy 2 or the money for policy 3 premium, but we know that the cash value will grow enough in policy 1 that we can leverage that to pay for policy 2 and policy 3 just like we did in the first 2 years. The insurance company, by the way, doesn't see these loans as separate. They don't see policy 1 as having 2 loans against it and policy 2 as having 2 loans against it. They just see a loan that's getting bigger. And this year it's going to get even bigger because we have to do this again to keep the cycle going. This is what laddering looks like. We've got a big loan against policy 1 now, and we also have a big loan against policy 2 because we got to pay for policy 3, which means that we have big interest now. Times 2, because we have 2 policies that have loans against them. And so you can see it starts out small in year 1, gets bigger in year 2, gets bigger in year 3. What do you think it's going to do in year 4? If you said the loans are going to get bigger and the interest is going to get bigger, you are correct. So you can see initially it looks pretty smart because you leverage this $10,000 and you got 3 policies, and these are going to grow for you over time. Let's go back to that conceptual illustration of inside a whole life insurance policy. This right here is death benefit. Remember, this vertical scale here is money, and this one here, horizontal, is time. Over time, your cash value, your premium remains level, which is why you can do this $10,000, $10,000, $7,000, and $4,700 every year. Your cash value is going to grow like this, exponentially. Well, here in the first years, it's kind of flat. It's not really growing that much. And so your return on these policies isn't up in this level yet. And it's not earning dividends as quickly as it will later on down the road, we hope. So borrowing this money just to fund more whole life insurance policies is sort of digging yourself into a hole, if that makes sense. because you don't have any return on these loans to help you make loan payments back. You only had $10,000 to fund these with. If you're not borrowing the money for a reason that increases your income, generates more income, or gives you a yield that allows you to pay back policy loans or at least pay off interest on them, this is a really, really bad idea. Don't ladder your whole life insurance like this, because what can happen is this interest gets so expensive you can't pay it, starts cannibalizing the policy, and you're going to start losing some of your assets. You may lose one, you may lose two, you may lose all of your life insurance policies. So although more is better if you can afford it, and sooner is better, you have to think long term, because it's better to have something long term than to have something short term that you can't keep. Something long term that you can keep going is much better than something short term that you won't be able to keep at all. And so it's important to pay attention to these two rules. And my dad's really the one who defined these rules and has shared them with hundreds of people, and it just makes sense. Number one, it has to be affordable. And number two, it has to be comfortable. So I ask you the question, is this affordable? Year one, is this affordable? Answer is yes, that's affordable. Year two, is this affordable? You're paying a little interest. Yes, this is affordable. Year three, is this affordable? Yes, this is affordable. Is this comfortable? No, absolutely not. And so even though this may not be uncomfortable, the important thing is to look out long term and see what's going on. Why would life insurance agents recommend laddering policies like this? Other than for the reasons they say they do, like you get better growth on more policies if you can leverage one to pay for the other, to pay for the other, to pay for the other. And they just say, very simply, well, you can increase your income. And maybe you can, and maybe you can't. That's not the point. But what would be the other reason for doing it? And the possibility is that because we get paid a commission every time we sell a policy, there could be some ulterior motives there. What do you think? Let's do this one thing before we close this video. Meet me out in the garage. I want to show you something. Welcome to the garage. Let's talk about laddering in real life. I've had this example here of 3 different ladders. These represent the different policies we were talking about: the $10,000 policy, the $7,000 policy, and the little baby $4,700 policy right here. All of these policies are great whole life insurance. They're going to get you some height. They're going to grow or help you grow if you need to reach something. This one's nice and stable. I can climb it no problem. This one here is nice and stable. It's good for smaller things, but still gets me the height I need. And this little baby one is a good, stable ladder. Think of these like those little policies. Now, if we're going to make it possible that we can have this ladder extend the effectiveness of this ladder, and the little ladder extend the effectiveness of this ladder, this is like laddering with whole life insurance. So I'm going to take this one, and I'm going to base this ladder on this ladder. So up we go. Put that one right there. And then I'm going to base this ladder off the other ladder we just put on top. Up we go. Just like that. Now I should be able to get higher because I've got the ladders stacked on top of each other. Now, I don't know about you, but this is not feeling very comfortable right now. And there's 2 rules that we need to use when we're determining whether something, our life insurance, our financial plan, is going to be effective. Number 1, is it affordable? And number 2, is it comfortable? Well, this is definitely
affordable, or doable, maybe we should say, but this is not feeling very comfortable. I could probably do this actually, but it's not very stable. I know what you're thinking. Why don't you just go get a ladder that's the right size so I can get all the way up there? That's a great idea. And if it's affordable, get the policy, the big policy that you really want, not 3 little policies like this. You see the dangers of laddering here? When interest and loans build up on these other policies and it gets overwhelming, eventually you're going to have to let a policy go because it's going to become unaffordable unless your income increases in some other way. The policies themselves yet are not efficient enough to get you the income you need to take loans and be able to pay those loans back. So it shouldn't just be based on the policies. You should be able to make more money with the money you take in a policy loan. Otherwise, you shouldn't be taking it in the first place. So if the big policy that can get you where you want to go is affordable to you, then by absolutely all means, do this instead of that. This is nice and stable. You know, this is doable and this is comfortable. I don't have any concern about stability or safety getting all the way up here with this ladder because it is made for this purpose. This is what it's designed for and it works very well. So if you can sustain the big policy, it makes sense. But if all you have right now is enough to get started with something like this ladder right here, this is a good ladder. You should get it because it's going to get you closer to up there. And once you can't afford something like this other policy over here, you'll have this one and you'll have another stable policy.
Hey guys, thanks for watching this video. If you enjoyed it, please give it a thumbs up. Also click the subscribe button to enjoy the latest content and newest videos on the channel.